Welcome to The Explainer. Today, we are conducting the absolute ultimate financial stress test. We're going to take a highly speculative, pre-revenue biotech stock, Taysha Gene Therapies, and run it straight through the legendary investment frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, as well as modern discounted cash flow modeling. It is the classic clash between old-school value investing rules and the high-stakes, high-reward world of modern biotech speculation. So let's dive right in. Here's our roadmap for today. First, we'll do a quick Taysha company snapshot. Second, we'll look through the Warren Buffett lens. Third, the Peter Lynch lens. Fourth, the Benjamin Graham lens. Fifth, DCF and modern valuation. And finally, our synthesis and final verdict. Starting with Section 1, Taysha Company Snapshot, Setting the Baseline. So, what exactly does Taysha do? Well, they're a clinical stage biotechnology company, and they focus exclusively on severe central nervous system diseases. Their absolute crown jewel right now is their lead clinical program, TSHA 102. This is an investigational AAV-based gene therapy specifically designed for Rett syndrome, which is a rare, absolutely devastating neurodevelopmental disorder. And right now, there are no approved disease-modifying therapies that treat its genetic root cause. So they are targeting a massive unmet medical need here. But it's crucial to remember that they are still very much in the clinical testing phases. Now, I want you to anchor your mind to this number, 597. That represents a recent high-end closing stock price that we'll be using as our baseline today, though the stock has been fluctuating down in the 572 range recently as well. This is the entry price we are trying to justify using our expert analyst frameworks. Let's look at their actual business reality, and honestly, it's pretty stark. Because they don't have any approved products yet, their revenue in Q1 of 2026 was literally $0. That's down from a modest $2.3 million in the same quarter the previous year. Meanwhile, their net loss was a substantial $42.41 million for the quarter, mostly because they are just pouring money into R&D. And this really sets up the fundamental tension for our explainer today, right? How on earth do strict value investing frameworks handle a company that is just burning cash to fund clinical trials? Let's find out in Section 2, the Warren Buffett lens, Seeking the Moat. There is a super dramatic contrast going on here. On one side of the equation, Taysha has a genuinely powerful regulatory moat. They've already secured orphan drug, fast track, and breakthrough therapy designations from the FDA for TSHA 102. That creates a massive barrier to entry for any competitors. But conversely, Warren Buffett demands consistent earnings, a high return on equity, and positive owner earnings. Because Taysha is entirely in the R&D phase, their return on equity and owner earnings are deeply, deeply negative. So, what would Warren Buffett's intrinsic value calculation be for Taysha today? Basically, zero. Yep, zero. Without consistent positive cash flow, you simply cannot calculate a meaningful margin of safety in the traditional Buffett style. He would 100% wait on the sidelines until they actually have an FDA-approved commercial product generating reliable earnings before he'd even consider buying a single share. Let's move to Section 3, the Peter Lynch lens, categorizing the story. You know, Peter Lynch loves to evaluate companies by putting them into distinct categories, things like fast growers, stalwarts, or asset plays. Given Taysha's current financial structure, Lynch might actually look at this and see an asset play. Why? Because right now the company is sitting on a veritable mountain of cash relative to its liabilities. That's a tangible asset Wall Street might actually be mispricing while everyone is just waiting around for clinical trial data. Let's walk through Lynch's checklist. Right off the bat, we hit a snag. We can't calculate a PEG ratio, that's price to earnings growth, because, well, they have no earnings to divide by. But look at their balance sheet. As of Q1 2026, they boast $276.5 million in cash and equivalents against just $88.4 million in total liabilities. That gives them a stated cash runway extending all the way out to 2028. For Lynch, that incredibly strong balance sheet makes Taysha a fascinating stock to hold, especially for investors who closely monitor insider and institutional buying to gauge confidence in those ongoing trials. All right, Section 4, the Benjamin Graham lens, the defensive investor. You kind of have to embrace the irony on this one. Putting a pre-revenue gene therapy company through Ben Graham's rigid defensive checklist is literally like fitting a square peg into a round hole. Adequate size, sure, pass their real enterprise, but earnings stability, fail. Dividend record, definitely fail. Moderate price to earnings ratio, complete fail, considering they just reported a negative EPS of -12 cents for the most recent quarter.
And this brilliantly illustrates what happens when we try to use Graham's famous intrinsic value formula. That formula takes the square root of 22.5 multiplied by EPS and book value per share. When you plug a negative 12-cent EPS into that, the math just completely breaks down. You literally can't take the square root of a negative number in finance. So for Graham, the value today offering absolutely zero margin of safety is unequivocally $0.
Let's shift gears. Section 5, DCF and modern valuation, pricing the potential. When Wall Street analysts look at a biotech like this, they build a discounted cash flow or DCF model that projects years into the future, specifically to the moment a drug actually gets approved. Current highly aggressive revenue projections model a leap from roughly $2.2 million in year 1, jumping to $43.4 million in year 2, and then absolutely exploding to over $127 million by year 3. Analysts take those future free cash flows and discount them back to today using a highly elevated weighted average cost of capital just to account for all those trial risks. But they don't stop there. They also run reverse DCF models to see what growth rates are implied by the current $6 price tag, and they look at enterprise value to R&D multiples of similar biotechs to really triangulate a fair value. And all of that speculative, forward-looking modeling brings us to this target number, $13. Based on these DCFs and comparative multiples, 12-month analyst price targets actually average around $11.62 and go all the way up to $13. Think about that. That represents well over 100% upside from our baseline share price, but it's built entirely on the mathematical probability of FDA approval and successful commercialization. Finally, Section 6, Synthesis and Final Verdict, Weighing the Odds. This really captures the profound duality of investing in clinical stage biotech. Warren Buffett and Benjamin Graham look at the negative earnings, the absolute lack of dividends, and say, nope, the fair value today is zero. They require a margin of safety that simply does not exist here. But modern Wall Street models look at the positive clinical data from the trials, the FDA alignments, the massive unmet medical need, and they forecast a speculative fair value somewhere between $11 and $13. So let's break down our final recommendation based on everything we've looked at. The fundamental strengths are undeniable, right? They have incredible FDA alignments, including an agreed pathway for a potential broad label and a rock-solid cash runway into 2028. But the risks are equally real. You have the ever-present threat of clinical trial failure, regulatory hurdles, and continued high cash burn. Our verdict? We're calling this a speculative buy strictly for high-risk tolerance portfolios looking for that triple-digit upside. Now, if your personal investment style aligns more with the traditional gurus, your trigger to buy isn't today. It's waiting until Taysha actually reports their first commercial revenue and a positive EPS. I want to leave you with a provocative question to chew on. Is the massive, potentially life-changing upside of a breakthrough gene therapy actually worth ignoring the safety of Benjamin Graham's math? In the biotech world, traditional valuation often takes a back seat to clinical probability. And at the end of the day, it all comes down to your personal risk tolerance. Thanks so much for joining me on this deep dive into Taysha Gene Therapies. I'll see you on the next explainer.